Welcome back, Alejandro. We're excited to talk about this company called CASY's that you discussed with me a little bit before. And I'm so thankful that you're willing to share your investing insights with the audience. And I'm thankful that you're going through all this information because it helps everybody to become better investors. So welcome back, Alejandro.
Thank you, Michelle. Yeah, I appreciate to be able to be here again. As you said before, we discussed this a little, and I found some very interesting things about this company. Not many people might know because it's only in 16 states in the US, but we're gonna find out and maybe for some get into the boat and maybe invest on it.
Sounds good.
So let's get started. So what is CASY's? I mean, it's a convenience store. It is the third biggest convenience store in the United States behind 7-Eleven and Circle K. But the fun fact is that it's the biggest one for American owners because 7-Eleven first is owned by Japanese group and Circle K is owned by a Canadian group. And then their format is more franchise, different from CASY's that they basically operate all their stores. As I said, I mean, it's a convenience store that sells gas in the Midwest part of the US. It sells food, beauty items, cat items. They, in certain shops, they have some car washes. It honestly depends with the traffic. And as we're going to see later on, they own the real estate. So they are really able to adapt everyone's stores to what the market needs, different from most gas stations that when they rent, I mean, they cannot just modify anything. They decide to buy the space. Something very special about them is that they have very good prepared food in the stores. And this, as we're going to see later on, is one of their biggest margin items. They're very famous for their pizza. Mm-hmm. They have around 2,500 stores, growing at around 4 and 5% in the last few years. And the rewards program is composed of 6.4 million members.
Wow.
Yeah, it's pretty big, but as I said before, they're only in 16 states, so basically they have 36 to go.
Yeah. And do you think that are all of the store locations also featuring gasoline, or not all of them are also including fuel?
Yeah, they all include fuel.
Oh, really? Wow, that's a lot of locations.
Yeah, absolutely. So they do all include fuel. They have 4 different brands. Some they have bought, some CASY's obviously is what they started. So Buc-ee's and Mini Mart are 2 brands that they are trying to get transformed into Good Stop or CASY's, because I mean the strongest brands are those.
Well, and can I ask real quick with Buc-ee's, is that different from this other one that spelled like Bucees? I think there's some like the other Buc-ee's or Buce's, I don't know how it's pronounced, but I've seen them along Interstate 95 going down to Florida. Like, have you seen what I'm talking about? It has like a squirrel or a chipmunk character that's on that, like, also almost sounds like Buc-ee's, but it's like spelled Bucees.
To be honest with you, I'm not 100% sure if it's different, but I would think it's different.
Okay, all right, probably is different then.
And where are the stores located? Like 50% of their stores are in an area with less than 5,000 people, 24 between 5,000 and 20,000, and 26% are located in population of more than 20,000. So as we see, they're located in very small areas. If special notice that, I don't know if you remember, but Walmart, when he started in very small places and he grew from there. So it's a very special correlation, I guess. Obviously, you learn a lot of stuff from growing in these places, and at the same time, you don't compete with many of the big guys because you are just competing with, I mean, just little mom and pop shops. So this gives them a big advantage. And again, in business, we're always looking for advantages, and I guess this is part of their strategy. And Most of the states that where they are located are like not like low income states, but they are not like in New York or LA. I mean, they're more like again Midwestern part where the average salary is not that high.
Right.
So how do they grow? I mean, as we see from 2022 to 2023, they have around 80 new stores. They constructed 34 of them and they acquired 47 of them. So again, this is a very interesting thing because they are very opportunistic in their growth. And one of the good things about them is that this is a very fragmented market. I believe that 7-Eleven has the biggest share of market and they have less than 10%. So what's good about this is that the scale really helps you here, you know, and obviously there's many groups that have like, I don't know, 5-10 gas stations, and what these guys do is they just, I mean, if they get a good price, they just buy them, and with their scale and their distribution centers, I mean, they just get a cheaper operation, which obviously makes them more profitable and a better business than being owned by just one mom and pop that has 5 stores. So I mean, that is really good for them and for us as investors if we think that we like this company.
Okay.
Here are the self-divided, and this is, to me, this is one of the most fascinating parts of every company, to understand what they sell, how much they sell of each item, and how do they make the money, because as we see, they sell 12 billion in fuel, but as we know, fuel is not a very high margin item. So that makes it a part of the business. But as we see, like, for example, prepared food, they just sell 1.3 billion of that, but they almost make about the same money than selling 10 billion in fuel. But to me, it's really interesting because it's a circle thing. I mean, because you always have to get gas, but if you like the food that they sell at the gas station, you become like a recurring customer to that place. And I think they're been very, very successful with this. I didn't bring a graph, but the graph of their stock is really going like super up, like super straight.
Wow.
So it's very interesting. And again, I mean, we see here how the division of the sales are, but what every item makes. So the prepared food is very high margin, and again, people love it. Their picks and all of that.
Yeah. And I've heard something similar with a lot of convenience stores that have the gas stations with them, is that most of the time the money makers are really what's inside the store with the food and the beverages. And it's not so much about the fuel as much as it is about the food, right?
Yeah, absolutely. I mean, for example, here in Florida, we have Wawa, which
Mhm.
I think for cases to compete with Wawa would be hard because they're really. Do you have Wawa?
Yeah, we have Wawa up here
Oh,
too. It's very popular in Pennsylvania and
yeah.
South Jersey as well.
So yeah, I mean that's how Wawa is here, and I think they have the same business model, but they are very, very strong in here in Florida. But Casey's is bigger than them, so.
Oh yeah. Yeah, and I think Wawa focuses more on like subs, like sandwiches or heroes.
Yeah,
Hmm.
yeah. But they've been doing a lot of propaganda with pizzas. I don't know if you've seen it.
Yeah, I
Haven't.
went to Casey's website and I see like you could get 2 large one-topping pizzas for $9.99 each.
Yeah, so I mean it's a high margin item, but at the end of the day, $9.99 is not much. So I mean it's like a good price for the buck, and especially for people that, I mean, just going to a gas station, and yeah, it's a good thing for the customers.
Right.
So the balance sheet has very interesting things. Receivables and inventory equal around 496 million, and accounts payable 560 million, which means basically their working capital is almost negative. So I mean, they're really financing their stuff with the suppliers' money. But property, plant, and equipment was something that really interested me. And as I said before, they own their stores. I mean, they buy the land, they develop it, and they apply the different aspects that they think are going to make it profitable for them. And this is a company valued at 10 billion in the market. So basically, net tangible assets is 4.21 billion, which to me, I mean, that's a huge number. That means they are not very like, their return on capital is not that big, but I think they play the card to the real estate. And with high inflation these days, let's say that in the next, I don't know, 5 years, you get rent bumped by 5% compound annually. CASY, being owner of their stores, are not going to have this, and they are going to have that embedded value in their properties. You know, I mean, their properties are going to appreciate in time. So it's kind of like, to me, investing in CASY is a little of a real estate play, you know?
Yeah, it kind of reminds me of McDonald's, except McDonald's is franchise, but the main, like McDonald's is mostly a real estate company, really.
Yeah, I mean, McDonald's is a very capital intensive business as well as CASY, but again, I mean, they do dominate, and the appreciation in value of their properties, I mean, protects you from inflation, for example. So I mean, it's a good thing.
Yeah.
So the cash flow, as we see, I mean, they keep growing. So the depreciation, I compare always to purchase of property and equipment, because I mean, if let's say depreciation was 300,000 and purchase of property and equipment was 300,000, that means, I mean, they're not growing. But as we see, I mean, they've been investing in a lot of new stores. I missed the years in that picture because it was a little small, so sorry.
That's okay.
But in the year 2021, they bought, like, I think overall like 150 stores from big guys. I mean, some were from Circle K, and the prices were different. And again, a gas station can go from 10 million to like 1 million. It really obviously depends on the volume and location. So, and the estimated economics per store, which to me in retail, this is the exercise you really have to do to understand every company, because it's a very good way to be able to project how the incremental capital or the capital they make, if they reinvest it, I mean, what are you going to make on that money? And the easiest way is to just go to the simplest thing. And the average cost to build or buy a new location is 2.5 million. And their sales per store is around 6 million. But obviously, as we said, fuel is 2/3 of that, and that's not very profitable. So the net income per store is around 200,000, a little below 10%. But that embedded value in that price of the property is what I think is a play if you think this is a good company. So again, a real estate play. That's how I kind of see it.
Yeah.
And again, I always like to also see the structure of the debt. As we see, is basically divided in the next 10 years. The rates are very good. When you see good rates, in my perspective, means the lenders trust this company. I mean, the fact that they have big real estate, the debt is not that big. I mean, just 1.6 billion, as we saw before. It gets them to borrow money at a very good rate. But obviously, I don't know how they're going to see the near future, just because with inflation being so high, if, for example, they decided to refinance some of the debt, I mean, when your return on capital is a little below 10%, and you are paying 7% on interest, I mean, you're basically doing nothing in certain ways. So I'm not 100% sure how they're planning to do this. It'd be very important to listen to their earnings calls to see how this is looking. And yeah, I mean, that's basically what I had for you today. I mean, again, I like the recurring revenue. I like the strong brand in the Midwest. And if you're interested, I mean, I think it's a good company to study if you like retail. But again, as we know, and Buffett always says, I mean, in retail, I mean, there's businesses where you have to be smart only once. The retail business is not that. The retail business is hard. Everybody wants to copy you. Everyone wants to lower your price. And I mean, it's hard to compete in this business. But again, the brand sometimes can beat that.
Yeah, like how to be differentiated from other competitors. And part of what stands out to me with when you're mentioning about the debt is I'm not sure how much more debt they're going to need to have in the future, like if they need to borrow more money to expand more, or if they feel like they're at a good rate and they don't need to, necessarily borrow as much to like make new stores. So I wonder, if they're kind of biding time, because I heard from the Wall Street Journal that some companies, like usually smaller size companies, might struggle if they need to get loans at higher interest rates because, that's a lot of money to have to pay back, and they need to be able to clear that hurdle if they want to make any profit. So being that Casey's is a significantly bigger company, maybe they can, generate some of their growth from their own earnings power, and they don't need to rely as much on debt, perhaps. But like you said, it would be helpful to see in the future earnings call what the CEO might say or the CFO, and see kind of what their anticipated future debt load might look like, right?
Yeah, absolutely. Especially with cases being such a capital intensive business, because I mean, they have to, I mean, they buy the property. So, I mean, it's very capital intensive. That the returns are decent. And as I say, the implied appreciation of their land is very good if you like real estate. And I think, like you said, like McDonald's, I mean, that's what they do. But again, with rates being so high, I mean, it's a big question to ask, because, and the problem is, like, management always want to show result. They want to show that they did something. So, I mean, in case you want to invest in this company, I mean, you really want to read a lot about their management, because, I mean, it's very interesting to see how they think about this. Like, for example, yesterday I was listening to Bill Ackman in CNBC All Alpha Summit, and he was saying that he thinks that rates are going to keep going higher. And again, I mean, we as investors need not to think about predict interest rates or anything, but I mean, this guy knows a lot and he has done great bets in the past. So if he says that, at least it gets you that doubt. So I mean, that is very important to be able to manage correctly at this moment in time, in my perspective. What do you
Yeah.
think, Michelle?
Yeah, I agree. I think it's going to be a big indicator of business health in the future of, trying to expand and make more business activity, because often leverage can help businesses do more initiatives to grow. And if they don't have as much coming in from just normal earnings, they might not be able to expand as much because it's too cost prohibitive to borrow at higher interest rates. So it's kind of like a little bit challenging for both businesses and consumers. Like, just the same with how everyday people might struggle to get a mortgage for a house if their mortgage rate's 7%. And then all of a sudden, your mortgage payment isn't $1,500 a month anymore, but like $2,300 a month. So it becomes a lot more challenging, I'm sure, for both consumers and businesses the longer that rates stay higher. So yeah, I think you're right that it's going to be something to keep an eye out on for a lot of businesses, but hopefully that wouldn't hold back the progress of Casey's. And it looks like they have a pretty good thing. Like at least they have a reliable income source from the prepared food, and it looks like their pizzas must be popular because that's like the main thing they advertise. Like I'm not from the Midwest, so I had no idea about the existence of Casey's, but clearly, when I went to their website, like the first thing I saw was a pizza offer. So I thought if I had no idea what this was, I would have thought it was like a Domino's or something, but it's not. It's like, an all-in-one where you can get your fuel and food and groceries. So I think that's pretty compelling. And I think another area that people would probably need to look into is how many competitors there are that do something similar to Casey's, and are they as good as Casey's at the same things, or is there enough differentiation that Casey's has a durable competitive advantage that, you know, there's so many probably similar things, like there's also Quick Check here, and there's Pilot Travel Centers, there's other entities that also have this rest stop and food stuff going on. So it makes me wonder, how big is the market that Casey's can still grow in it, or are they reaching, you know, their kind of full market share that they're able to realistically, you know, grow into?
Yeah, absolutely. And as we saw before, I mean, they're located in like small areas. So I mean, one thing is competing with mom and pop shops, and one thing is competing with maybe one of the big guys. So I mean, especially in this capital intensive business where they are buying the real estate, which I think is crazy. For example, if we see like a Starbucks, I think that return on capital in the States is like 35%, building a store, and I mean the return they get on that investment. I mean, Casey's is 10%. And
Wow.
again, I keep mentioning the implied value of the appreciation of their land, but I mean it really is a important factor to think about.
Yeah. Yeah, definitely makes me wonder how you value real estate with this kind of business. Like, or also makes me wonder if the competitors are doing similar things, or if they're more of a franchise model and don't own the real estate, because that could affect the valuation of these companies. But it looks like Casey's must be doing something right for their stock price to keep going up.
Yeah, absolutely. And I mean, yeah, I mean, for example, 7-Eleven is franchise model, so yeah,
Yeah. So
and they're the big guys, so yeah.
yeah, it makes me wonder, is 7-Eleven a direct competitor, or are they kind of different because of this underlying fundamentals of the, you know, real estate versus franchise model?
I mean, I think there's different, but I'm not sure how big is 7-Eleven where these guys are, because for example, like I said, I mean, there's 50% of their stores are located in places with less populations with less than 5,000 people. So I mean, I don't think, or they might be couple 7-Elevens, but again, their scale, I don't know if it's that concentrated, because these guys have distribution centers 500 miles from every store. So I mean, they're very structured in that way. I'm not sure how 7-Eleven works in that, for example, to get the lowest cost per gallon of fuel, which I mean, even though it's a low ticket item, a low margin item, I mean, you win if you get the lowest price, obviously, because it becomes a generic. So
Mhm.
I, from what I read, I mean, they're very well managed in that way. So they're
Oh, that's
really
great.
very structured in the way they grow. So yeah.
Okay, cool. Well, I mean, that's pretty interesting. And I appreciate you sharing all this knowledge. And as you can see, like if you are an investor like Alejandro and I, you want to ask these tough questions and really dig under the covers and understand, you know, how does this kind of company measure up against some of its competitors, or are they not really competitors? Because even though sometimes companies look like they're doing the same thing, maybe when we dig under the surface, we realize that there are some differentiating factors that give them either better or worse staying power in an economy. So I think that's great. And also, I think a nice thing for Casey's is that they seem to provide a valuable service of groceries if it's in more rural locations. So maybe, you know, sometimes a lot of rural towns have lost supermarkets. So if Casey's has replaced that need, then that's offering a valuable service to many communities.
Yeah, absolutely. And what you just said just made me think about one question they asked Warren Buffett in the one of the annual meetings, and they asked him about what was the difference between Dairy Queen and McDonald's, because the person said like, oh yeah, McDonald's and Dairy Queen are the same, and definitely they're not the same. As you said, McDonald's owns their locations, while Dairy Queen just has like, I think 8,000 stores around the world, and they just operate 30 of them. So basically, they're very capital light business, different than Casey's. But as you said, it's very important to understand what their competitors are doing. And in the case of Dairy Queen and McDonald's, people think, oh yeah, they're the same business, but they're definitely total different business.
Yeah, absolutely. So yeah, that's great to know and great to keep in mind. So thank you so much, Alejandro, for going through CASY's and explaining its business fundamentals. I think it's super helpful, and I'm greatly appreciative that you go on and do this with me. So thank you so much.
Absolutely, Michelle. Thanks for having me. It's a pleasure.
All right, till next time.